Welcome back to our channel. Here's a question that could impact the value of your business. Is your business paying fair market rent for the space it occupies or not? Now that's an important question because when we value a business, one of the biggest adjustments we make is to the business's occupancy costs, specifically its rent. And getting that number right can make a huge difference into telling us what your business is actually worth. Getting that number right is a process called normalizing the rent. Now, every business needs space, a nexus, if you will. But when valuing a business, we need to know what that space would actually cost at fair market value. Whether you own the building or lease it, calculating and adjusting the occupancy cost of your business is what we mean by normalizing the rent. We adjust the rent to reflect what a buyer would expect to pay for the same space if they were to buy your business. Now, why does this matter? Well, there's a couple of reasons that this is important. First, rent can and often does distort earnings. If you own a building and charge your business below market rent, your expenses are going to look artificially low, your profit is going to look artificially high. And that means that the valuation that you arrive at for your business is going to be inflated. And when we see a business like that, it usually means that the business owner is using the rent to keep the business afloat. This is a big red flag for buyers, as you can probably imagine. And buyers, during their due diligence, will discover this anomaly. And they'll figure immediately that something's wrong. Now, on the flip side of that, second issue is if you're paying above market rent, your expenses are overstated, your profits are understated, and the valuation that you arrive at for your business is too low. It's almost certainly worth more than that. Now, why would your business be paying above market rent? Well, it's possible that you got into a bad lease a number of years ago and you're waiting for that to play out. But when we see above market rent, it often means that the business owner also owns the real estate and is generally financially astute and is lowering the business's taxable earnings by shifting some of those profits via the higher rent to the real estate, where those profits are generally sheltered from tax implications. So either way, when selling a business, we have to adjust the rent expense to market levels before applying any multiple to arrive at a valuation. So how do we do this? How do we normalize this rent? Well, normally we do 3 steps. Number 1, we determine what the market rate would be. We look at comparable properties in the area, similar size, similar space, similar conditions, similar type, to find out what the going rate per square foot is, and then we make general adjustments similar to what an appraiser would do. Next, we compare that to your current rent. And if you're paying more or less, we adjust the rent expense to reflect that price. And finally, that adjustment becomes part of the financial recounting process that we go through, and it shows up in your discretionary earnings. And remember from a previous video, discretionary earnings are what we're trying to get to, the true earning power of your business. This gives us a true picture of what your business earns and what a buyer can expect going forward. True earning power of the business is what the buyer is buying. Now, for example, let's say your business pays $10,000 a month in rent, $120,000 a year. But by looking for comparable space, we discover that you could get a similar space in your area for $8,000 a month, $96,000 a year. That's a difference of $24,000. If we then adjust your rent expense down by $24,000, your discretionary earnings would increase by that same amount. Now, if we were valuing the business and applying a multiple of, say, something between 3 and 4 to your discretionary earnings, that adjustment alone would increase your business's value by something between $70,000 and $100,000. This matters. So, when valuing a business, we normalize the rent along with other expenses so that we're looking at the business the same way a buyer will. Remember what we've mentioned in multiple videos. What the buyer's most fundamental question is: what will this business put in my pocket? If the rent isn't realistic, neither is the valuation. So if you own your building or have a lease that's not exactly at market, make sure that you adjust the number before estimating your business's value. Your business's value will either go up or go down, but it needs to be accurate or nobody is going to take it seriously. If you're not sure what the market rent is, ask a professional business broker or a commercial real estate broker. Either would be happy to help you figure it out. In our next video, you'll learn about 2 businesses from our files that had rent-related adjustments made during our valuation process. One ended up with a happy business owner. The other ended in disaster. So subscribe so you don't miss that video or our subsequent ones. If you found this video to be helpful, hit the like button and check out the rest of our What's My Business Worth series, where we explain how to value, price, market, and prepare your business for sale the right way. Links to that series and to many of the other resources that we provide are in the description below. In the meantime, thanks for watching. I'll see you in the next video.